So in this video, I'm going to show you guys the top 5 stocks that you don't want to miss out on for September 2024. I'm going to point out that in this video, I'm going to go over technicals like price to sales ratio if the company's not profitable. This shows and gauges how to address this company if they're not profitable. There's 2 metrics I'm going to show you guys in this video. One is price to earnings. If the company is profitable, it will show you what their price to earnings ratio is. The lower, the better. Good companies with 20 to 30 is ideal. Lower is even better. Most companies find their way between 30 and 50. However, if the company's not profitable, well then price to earnings is useless. So we have to look at another metric called price to sales, which gauges the company's ability to generate cash flow or total sales revenue and incoming cash, and their ability to potentially generate profits later on down the road. I'm going to show you guys how to implement these strategies into your portfolio as we go through the top 5. Before I get into the top 5 stocks in this video, we're going to talk about a lot of things like price to sales, price to earnings, market cap, outstanding shares, shares float, technical analysis. If these things confuse you and you don't understand them completely, whether you're a beginner or you're an intermediate, you've been in the stock market for a while, or you're just getting started, if they confuse you, you're looking to get better, maybe you're losing money in the market, which we all are at one point or another. We've all been there. If you guys are looking to take control of your financial freedom, I would love to help you, but it's a very serious mentorship. You have to be serious and committed to growing your wealth to achieve financial freedom, time freedom, and location freedom. You guys can sign up on my website at any time at investwithcorey.com right there on the screen or in the information box below. Most of my students have made 30% on their portfolio in the first 3 months. If you're looking to take control of your financial freedom and make profits and learn, flourish, and grow, I would love to help you, fam. I really would. It drives me every single day. I look forward to speaking with you soon to help you grow your portfolio. So we're going to start things off without further ado. Number 5, Sofi. So we're going to start off by looking at Sofi, and you might be asking, why is Sofi such a good investment? Well, when the rates get cut in September and PMI data comes out, it's only going to help a fintech like Sofi that has student loan debt and other issues because they're a fintech. So we're going to go ahead and look at Sofi. I'm going to show you guys some metrics and how we can gauge how well Sofi is doing. So first off, we're going to take the stock price of $7.67, and then we're going to compare it to Robinhood. So $7.67 divided by 1 cent EPS, but their previous 2 quarters was 2 cents. So let's just give them the benefit of the doubt and say 2 cents. That's a 383 PE ratio. Now, if we look at their price to sales, we're going to take the market cap of $818 billion. There we go. Divide that by trailing 12-month revenue to get our price to sales, which is 3.40. 340. So we have a 2.4 on price to sales. Well, what does this tell us? Well, Sofi is likely to become very, very profitable with year-over-year growth, and a 2.4 is great. It's very good for a company at this price. Now, let's look at Robinhood. Same exact thing. We're going to take $20.96, and we're going to divide 21 cents EPS, giving us a PE ratio of 99. 99 is kind of high, a lot better than 383, but let's see what the price to sales is. 18.54 billion on market cap. Divide this by 226 billion in total revenue. Price to sales of 8.2. So you can see Robinhood has a PE ratio of 99, but Sofi's is 383. However, the price to sales on Sofi is 2.4 versus 8.2 on Robinhood. Now, market cap is 18.5 billion versus Sofi's market cap, which is 8.18. However, the shares float is 1 billion, and on Robinhood, the shares float is 586 million. Now, because Robinhood has less outstanding shares, this is, of course, why the stock price is higher. Now, the market cap is also higher than Sofi, 18 versus 8. It's over double the market cap. However, you also have to look at 1 billion shares float, double the amount of shares, meaning the price of Sofi is going to be cut in half. So if they had the same share float, Sofi would be about $14. So they're not far off from Robinhood, because Robinhood was at $14, $15 only about 6 months ago. The price of sales being as high as it is means that we could see Sofi at $10 to $12 by the end of the year if the next few quarters go well on the earnings and interest rates get cut. My price target this time next year for Sofi is $15, signifying a 120% return from this summer. Sofi, very good company. It's why I picked them as the number 5. So the price of sales illustrates based on on market cap, based on EPS, PE ratio, overall revenue, the rates getting cut. I'm taking into account everything. Sofi is going to fly. Today's number 4 pick, Affirm. Now, Affirm just partnered with Rona Hardware, the largest one in Canada, and Hotels.com, which is huge in the United States. They're making strides, and they also suffer because of the interest rates and inflation that's been going on over the past couple of years. But let's take a look at the price to earnings and the price to sales and compare it to PayPal. So Affirm, we can't do a price to earnings because they're not profitable on EPS, but what we can do is a price to sales. So we're going to take the market cap of $985 billion, and we're going to divide that by their total revenue for the year, which is 2.11, giving us a price to sales of 4.66. PayPal, on the other hand, has a market cap of $73.65 billion. So $73.65 billion divided by their total revenue trailing 12 months, which is $31.04, and we get a price to sales of 237. Now, might I add, PayPal's PE ratio is quite good. 72 divided by 1.19, giving us a PE ratio of about 60, roughly. Now, the market cap is $73 billion. Outstanding shares, shares float, 1 billion. Affirm's shares float is 248 million. So only a fourth of the shares are floating right now in comparison. So that right there is the reason why Affirm's higher than it would be. If they had 1 billion shares floating like PayPal does, they would have a price of around $7 or maybe $8. It just depends. Things are, there's no real set number, but it'd be somewhere around $7, $8, $9. Now, you have to also take into account the market cap. So the market cap is 1/7 of PayPal. So realistically, we have to also account for the fact that the price to sales is significantly better on PayPal. But for a company that's got a $70 billion market cap and that is generating $7 billion a quarter, $31 billion a year, which is 16 times more revenue than Affirm, Affirm's PE ratio is not too far behind. If Affirm can progressively get better on their earnings and become profitable based on price to sales number, market cap, and shares float, it is all pointing to a value of around $45 or $50, meaning that Affirm could really, by the end of this year, first quarter of next year, be in the 45 to 50 range quite easily. But just pricing in, if Affirm can break even at, say, 1 cent EPS, 0 or 1 cent in the positive, that would realistically put Affirm with good revenue in the next earnings report, that would put them around $40 to $45. If Affirm had 1 billion shares float, then the price would be 1/7 roughly of PayPal. So you figure PayPal 72 divided by 7, it'd be about $10.20, but then you have a quarter of the float, so times 4. So there's your number right there. So 41 is exactly what I was telling you. Based on price to sales, Affirm has a very high probability, and that's without any future guidance, of hitting $40. If this earnings is good and the guidance is even better, Affirm's going to go to about $40. And this is why I make Affirm number 4, because the price to sales clearly illustrates pretty massive growth going forward. And they're the big dog in the yard. Afterpay sucks, Klarna sucks, and PayPal is like a one-stop shop. They're a jack of all trades. They don't specialize in buy now, pay later. They're trying, but they don't. It's not like Affirm when you pay in 4 simple payments. Affirm is a monthly payment for a year or two. It's a buy now, pay later, but like a loan. Nobody does it like Affirm. They've been around longer than Klarna, longer than Afterpay, and they've been doing this longer than PayPal has. So I guess when you look at it, it's like when Block came on the market 13 years ago, they were thinking they were going to compete, knock PayPal out, or give them trouble. Not really. They're kind of different companies. They're not the same. PayPal is not going to be able to just oust Affirm. It's not going to happen. Affirm's already well established, and they're already in a lot of partnerships, and they're already working on profitability, and their price to sales is great. That's why it's number 4. You don't want to miss Affirm. In fact, Affirm might be a buy right now before earnings. When you're watching this video, don't even wait for September. I would buy now. Moving up from our 4th pick, which was Affirm, to number 3, we have Starbucks. This is a great company, but they had a really bad CEO previously. They just took the CEO from Chipotle. They have gap filled down, got the new CEO, and gap filled back up. This is a company that has potential to turn everything around, and considering they have reached highs of $117 to $130, and you can get it now between $90 and $95. Now is the chance to get into a very solid dividend stock and make good profits. This is a company that has great dividends. We look here, and the dividends is $57 for every 100 shares. The yield isn't super high, but it's still pretty good, and you can make good money selling covered calls, and you'll make money on the stocks. But let's look at their PE ratio and performance to sales. The stock price is $95.63. You guys should have got in when I said a month ago at $74. I called it twice in separate videos, but now it's $95. So now you got to pay the premium. 93 cents is the EPS. We have 102 for the PE ratio. In order for Starbucks to be really good on their PE ratio, they would need somewhere around $1.30 to maybe $1.40, which is possible, but next quarter is going to be like $1.04. We're working in the right direction. Market cap, $108.37 billion. There we go. Divided by their 12-month revenue, $36.45. Price to sales of 2.9. That's just about as good as PayPal and better than Affirm. So this puts them on track. They're really a great company. They got a new CEO. Price to sales is good. Price to earnings needs a little bit of work. Revenue is good. The real problem is the fact that they got some debt, but their cash flow is good. $1 billion in cash flow. Trailing 12 month is $4 billion. Very solid company with good dividends. They gap filled down and gap filled up. This area is pretty solid, and it gapped down and gapped up. I mean, that says it all. So I would say that you see it gap down and then it gap right back up. That's quite crazy, to say the least. But in any case, this is a great stock to get into. Definitely would not hesitate to buy up Starbucks. The move on Starbucks, my price target for the end of the year is 110 to 115. So there's some good upside plus dividends. My number 2 pick is Nike. Let's go. So Nike is a great pick, and I'm going to explain to you why this is something you should invest into right now. Number 1 reason, first off, it's a great dividend stock, not quite as good as Starbucks, pretty close. Nike gapped down, and this happened with a lackluster previous earnings because they missed revenue and their guidance wasn't good. However, they're on the move, working their way back up. The earnings estimate on EPS for the next quarter is 53 cents. The previous was $1.01. They beat the EPS, but they failed to deliver on revenue. But let's look at some things about Nike. Let me show you why this company is so strong. At $84.28 stock price, we divide by the EPS at $1.01, giving us a price to earnings or PE ratio of 83.44, beating Starbucks, beating PayPal, and beating Affirm. Solid price to earnings. Not that good, but pretty solid. They can get it down to 70 or better, then they're really doing well. But 83 by no means is great or even good, but solid compared to all the other companies in the list. But what really matters now is that we see this. What is the price to sales? So let's take the market cap, $126.37 billion, divide this by their trailing 12-month revenue, which is $51.39 billion. We have a price to sales of 2.4. So this is a very good price to sales. It beats Affirm, it beats Starbucks, and is just as good as PayPal. So PayPal is a 2.37 price to sales and a 60 PE ratio, and Nike's not far off. Roughly the same, but just a little bit worse on the PE ratio. But that's due to previous revenue and the EPS. But this gives you a chance to buy Nike at a discount because Nike is trading really at a discount at this point in time. Cash flow, trailing 12 months, $6 billion. Previous quarter, $2.41 billion. Their debt, not very high. Only $1 billion in debt, but they got $37 billion in assets. So this should explain to you guys how strong Nike is. There is a lot of strength in Nike. $12 billion in a quarter for revenue. $51 billion in the trailing 12 month. Operating income is good. Pre-tax is good. Net income is good. EBITDA is really good. They just need to improve their growth. So I say that Nike is an absolute steal at $83 or $84. Nike spent a lot of its time, I'll show you the chart, at 102 to 105. These are the highs. It spent most of its time up in the 110, 115. It's dropped down here, which is kind of a flat recovery zone. 50 to 80, it was in that zone quite some time before and now after, but realistically, the fair value on Nike is between 100 and 115, like right up in here. So there is really a $20 to $30 move coming for Nike in the next year. That signifies a 30% return plus dividends plus covered calls. Nike is a stellar buy for September. Remember, these plays are long-term. You're not going to make 30% of Nike overnight. My number 1 pick for today's video might come as somewhat of a shock, but it's the honest truth. Number 1 is none other than Wayfair. Now, I've talked about Wayfair before, but this time I'm going to explain to you guys why Wayfair is the number 1 pick and why it is so strong. Stock price is $44.48 divided by the EPS recently of 0.47. Price to earnings on Wayfair, they went indefinitely negative to 94, which is better than Affirm, way better than Sofi, way better. So a 94 PE ratio. What is their price to sales? Well, their market cap is 5.49 billion. However, shares float is very low at 89 million, which is why the price is so high. If it was like a billion shares floating, this stock price would be like $4. Due to the low share float, that's why the price is so high. But let's take market capitalization, 549 billion, and divide that by their total revenue for the trailing 12 month, which is 11.9 billion. Wayfair's price to sales, 0.44. So with that being said, they have the best price to sales ratio of any stock in this list. And we all know Starbucks and Nike are strong stocks. So is Affirm. We all believe in Sofi, right? Well, price to sales ratio means for every dollar you spend, the return in their sales. Wayfair has extraordinary future guidance and value. The reason Wayfair is struggling right now is due to the interest rates not being cut, due to consumer worry, consumers not spending as much. They just launched Welcome to the Neighborhood campaign. They opened up a physical store in Chicago and they plan to open like a dozen more stores in the year 2025. When the rates get cut, PMI data comes out in the first week of September, all of this happens, the next earnings are going to be better. So we've got 2 more quarters coming up where Wayfair is going to be able to increase their growth, their revenue, their EPS, their earnings. And if the rates do get cut like they are supposed to, and almost for sure getting cut in September, Wayfair is going to improve between now and the New Year's because of just this one factor alone. With a price to sales ratio of 0.4, it pretty much says that Wayfair has the potential to pretty much double their stock price in the next 6 months to a year. At 0.4, with a low share float like they have right now, it is likely that if they can beat the earnings consensus yet again, and let's say the next earnings, they can maybe do like 20 cents, 25 cents, or even back to where they were previously at 47 cents and get even better in the earnings after that, we could see Wayfair run back to $60 or $70. This stock poses very strong guidance. With the rate cuts being cut consistently over time over the next year, Wayfair doing better and reporting better earnings, it will come as no shock to me to see Wayfair between $70 and $90 this time next year. That pretty much shows us that we have a double your money situation, a 100% return on Wayfair. This is a 2x return on Wayfair in the next 6 months to a year, depending on earnings and interest rates getting cut. Price to sales of 0.4 is really, really good. Like, let me show you a price to sales on Apple. This is 345 trillion divided by 385 billion in revenue. 8.9 price to sales. The lower the better. Wayfair has 0.4. That tells us that Wayfair has a lot of growth potential. As an investor, you want to be in the stock with the biggest return, right? Out of all the stocks on this list, even though a firm has got a 20 to 30% or more in the next 6 months, Wayfair's has 100% potential in the next 6 months to a year. And the premiums for selling puts and calls is really good, and the share float is fairly low considering the market cap. So this goes without a doubt as the best pick and the #1 pick in today's September top 5 stocks to buy. Hope you guys enjoyed this video. If this was kind of hard to follow with price to sales, price to earnings, and market cap and shares float, shares outstanding, and you just don't quite understand it, whether you're a beginner or you've been in trading for a little while, you're not profitable, you're having a lot of difficulty, I would love to help you, fam. Really would. It's what drives me every single day. If you guys would like to sign up for one-on-one coaching, full Discord to surround yourself with like-minded people just like us, and a full training course so you can take control of your financial freedom, I would love to help you. You can sign up at any time, investwithcorey.com, right there on the screen or in the information box below. My students, all of them, are making good returns. I have students that have made up to 30% in their very first month. I have students with $5,000 portfolios. In less than 3 months, they have $15,000. So if you want to grow and you want to get better, I would love to help you. Until the next video, guys, remember, it's a very serious mentorship. I can only help so many people, so spots are limited. I hope to speak with you soon. This video's over. I got another video for you guys picked out right there. And remember, until the next video, let's grow our wealth together. Take care, fam. Click the video, and I'll see you over there.